Thank you.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, CEO of KKM Financial, to discuss why liquidity is king at the end of the day. Jeff, I'm not even quite sure to start with you, but obviously, if we want to talk about Silicon Valley Bank, why it is kind of emulating some of those emotions we felt in 08, 09. I don't think we're systemically there, but kind of getting a little bit of flashbacks.
Jill, I don't think it's systemic by any means, but nonetheless, this is bothersome. We saw the VIX today jump up to 29, and here we are really trying to figure out and sort out going into the weekend, what is the ripple effect? What actually happened? And we know that like a bank like SVB, Silicon Valley Bank, I think they got caught. Maybe it's an amateur team managing their treasury book, but at the end of the day, they had a $1.8 billion loss. They weren't able to forecast potential redemptions to the maturity of the bonds they own. With the rate normalization process we've seen, this isn't wildly out of the box. They did a poor job of managing, that's evident, but nonetheless, I think it's isolated. I don't think it's systemic. And at the end of the day, to compare it to Lehman Brothers, I don't think that's fair.
Right. And, we're talking about assets. We've been talking a lot about debt servicing, but again, it all comes back to liquidity. What is available to pay when these things get called in? And, a lot of bond guys such as yourself have really been coming back to that, where liquidity, it matters. It's everything.
Liquidity 101, absolutely. But I think, the folks at Silicon Valley Bank did not take Liquidity 101 because they were clearly searching for larger and bigger and juicier yields. And it goes back to the floor, Jill. If you remember, pigs get fat, hogs get slaughtered. So here they were reaching for yield. And sure enough, there was, an IPO pullback, right? Just like the SPAC pullback we saw last year. So those ripple effects, this is all part of the consequences when you see interest rates. I'm going to say Fed manipulation. You didn't say it, I said it, but the Fed manipulated markets by having rates at zero for so long. But there is a shock absorber that's not getting enough illumination today, Jill, and that's the $8.4 trillion balance sheet of the Federal Reserve. Yes, they are exiting those purchases by $95 billion a month, but that is still, as of February, kept their swollen, lofty balance sheet at $8.4 trillion. So we are going to get through this. I think we are, at the end of the day, in a range in the S&P 500, but emotions get high. This is the different catalyst. No one really saw this coming, but I do not think this is the black swan. I don't think this is the first domino to fall down. All the banks, the major banks, the big banks, are well capitalized. Now, I'm not demeaning the fact that, yes, it was an S&P 500 constituent, was the main word there. Top 15 bank in the country. So I think this is a bank that's been around for quite some time, but it didn't really have to be conditioned or well-disciplined enough until we saw rates move in the way they did in the last 18 months.
Right. I think part of the issue is their involvement with the private markets, right?
100%.
And I mean, that's a little bit of a challenge because being able to value that, it's not mark to market like stocks are. And I think what's happening under their service, and we know what's been happening with private equity, what's happening with VC. A lot of these companies that Silicon Valley Bank worked with are the ones that get funneled through and then eventually go to the public markets. I mean, a number of household names have come through there. So I think, in addition to what's happening with banking, it's going to impact the private markets.
Well, just to add on to that, I think you're spot on, and that's a great point to bring up. But what's interesting is that you're not seeing market participants really discern that message. They're just selling everything. Look at KRE. That's the regional bank ETF. It was trading $60 just on Monday. Here it is under 50. And you've seen implied volatility absolutely surge. If you look at next week's options, look at the 47, 48 puts, they've surged up to 85 on an implied vol perspective. So it's just sensational to see that type of volume. You're seeing Schwab. Schwab's down 20% in 2 trading sessions. So you're seeing a lot of people getting nervous. You're seeing some profit taking, but I think this will get in the rearview mirror. I think we're going to be all right. And yes, we're under 3,900. Doesn't feel good from a technical perspective in the S&P 500, but I think this is the lower end of the range. And I think when you see the lag effect, 10-year note back under 3.7%. It was just above nearly at 4.1%. So that lag effect will help equities heal going into next week.
Yeah, and I wanted to ask you about that, Jeff. I mean, of course, with your experience cutting your teeth in the bond pits, yields came down. I believe it was almost 22 basis points in one session. That feels like a lot. It doesn't sound like a lot, but it feels like a lot in the fixed income space to see how rapidly yields had moved down this week. What does that suggest to you? What are investors thinking?
Well, I think, prior to, SVB coming out, you saw the 2-year, 10-year yield inversion really at maximum. You saw people getting really concerned about how hawkish will the Fed be. 50 basis points, if you remember on the CME FedWatch tool, it moved up nearly 50% all the way up to 75% just yesterday. It's now come back in line due to the fact we had the jobs number. No one's actually said jobs number yet, but we had a better than expected, but a nice kind of, Goldilocks 311,000 job number. But I think what the yield curves are saying is that it was oversold. The yields popped too high, the 2-year way above 5%. So it's come back in line. I think that's really important. My forecast and outlook for 2023 has had the 10-year note tethered to 3.5%, but you're seeing this emotion come into the market and move yields up and down too extreme. The pendulum always swings too far, but here we are with the 10-year note coming back down. But I think the last 10 basis points of that yield dropping has been people buying in the event they're going to miss out on these juicy yields. We may not see the 2-year back above 5% for quite some time, if again.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.